Hi Warren, it's Kerry. Thanks for a great podcast. I've got some follow-up questions from your interview with Finance Ghost a few weeks ago. He spoke about doing some of his own research into companies he might want to invest in. Could you please give us some pointers about what we should be looking at and what resources we should use to find this information? And secondly, could you please give us a little bit more information about how ETFs work? Is a particular ETF limited to a list of companies which they must invest in, and then they use math formulas to change only the percentage holdings of the different companies? Or have I misunderstood that? And how, broadly speaking, do these math formulas work? Or perhaps are there different mathematical models which underpin different ETFs and which would explain the difference in the performance of two different ETFs which invest in the same market, like two emerging markets ETFs, for example? And do you have any advice about how one should choose between two ETFs which appear to invest in more or less the same markets? Thanks again for a great show. Cheers.
Gee, Kerry, two fantastic questions. So firstly, just to talk a little bit more about ideas and pointers on how you buy your own shares, what you should be looking at, and then also just what sort of resources you can use to help you do your research. And then the second is explaining a bit more about exchange-traded funds, and especially how they work, and then the benefits of one versus another when they look very similar. So let's kick off on buying shares. I think, firstly, Kerry, this is a lifetime of knowledge topic. In other words, the answer I'm going to give you now is just some pointers, but really, there are some really bright people that have been studying how to buy shares for decades. Warren Buffett being a case in point, and they're forever learning and forever evolving their own style, their own philosophy. So I just want to say that I think there are multiple different ways and different approaches to how you choose shares, and certainly it's very hard to argue that one person or one philosophy is way better than another. I think it's too arrogant for people to say they've got the absolute recipe. And then secondly, I always want to remind people that Sir John Templeton was a very famous fund manager, stock picker many years ago, and there is a company named after him called Templeton Asset Management, or Franklin Templeton, and he said at the end of his very long career that he thinks he did really well. He made a lot of money for himself and investors by choosing shares, and he believes that he was accurate with 51% of his share picks. In other words, out of every 100 shares that he chose over his career, he chose well with 51 of them, and he made mistakes with 49. So I think the comment there is just to understand that actually when you choose shares, the odds are that most of the shares you're going to choose are not going to do well for you. It will be a very small handful that will deliver the most of the return, and others might give you an average return, but the bulk of them will actually lose money. So I think it's just important to know when you go in, we always have to be humble because the markets are always ever changing, and certainly the very definition of unpredictability. Anyone who believes that they can read markets and can read shares and can do that consistently over a long period of time is going to be proven wrong time and again. And I won't be the person proving them wrong. The market will do that all on its own. So do I still think that it's worth buying individual shares? I think certainly in the podcast with Finance Ghost, we made that point that there is a possibility of doing better than the market if you buy shares. So certainly I do think there is some merit in it. I do also think that it's not for everybody. Out of every 10 of us, maybe 3 people, will have the time, the inclination, the fortitude, especially emotionally, to be good share pickers, and the rest of us, the other 7 out of 10 of us, need to be clear that we might not have the skill, the time, or the ability to actually choose shares, and then it's much better to buy an exchange traded fund or a unit trust and outsource that responsibility to someone else. So after that lecture, Kerry, I think if I were to buy shares, the thing that I'm looking for is I'm looking for a company that has a sustainable long-term business model where it has the advantage over its competitors, and it has the ability to control its price in some way for the service or the product that it sells. So to give you a very clear example is, if you think about Apple, if you look at the Apple iPhone, I mean, I'm an Apple iPhone convert. I've owned iPhones since they were launched, and I know for a fact that when I buy the phone, it's more expensive than the comparative Android phone. And even if it's a Samsung, for example, the iPhone is generally more expensive. And truthfully, I'm not technically savvy enough to know the difference between the two phones. Certainly, probably I would get equal use out of both of the phones. But I am committed to the iPhone because I believe in the quality of the phone. I know the ecosystem of Apple. It works for me. And so the fact that Apple charges a premium for its product, I'm still willing to pay it. So it tells you that Apple have a pricing power over their phones and certainly over their Android competitors. Whereas someone launching an Android phone now, a new company might not be able to charge a premium for the product, even if they actually have the best phone in the market. And so that's pricing power. So important when I'm looking at a company, I want to know that they've got some sort of ability to keep earning money and to keep earning money at a profit compared to their competitors, even when markets go down or economic cycles change. So pricing power is important to me. I also like to know that I'm buying companies that have very strong balance sheets. In other words, they don't have a lot of borrowings. Ideally, they actually shouldn't have any borrowings, and that they have the ability to generate a lot of cash from their business in a month or a quarter or a year. And I don't mind companies sitting on decent amounts of cash while they are profitable and generating good sales. And the reason for that is, when an economy goes through a tough time, I mean, we all think about COVID now, the companies that didn't borrow any money before the time and companies that were sitting on a lot of cash were able to get through that difficult time much more easily than their competitors who might have been borrowing and had very bad balance sheets. Those kinds of companies, if they have a tough time, whether it's 6 months or a year, might find themselves in deep financial trouble and in fact might go out of business. Whereas a company that's got a strong balance sheet, that's got some pricing power, it can get through very difficult times much more easily. And in fact, it might actually be in a position where it can use its cash to buy competitors or to buy market share from competition in a difficult time. So for me, that's my second pointer. I like very strong balance sheets. And then thirdly, and that's very, very much a personal philosophy, is I like to invest in management teams that have significant shareholding in the company. I'm not a big fan of professional management teams that that earn big salaries and fat bonuses, but actually don't really care about the share price of the company over the next 10 and 20 years. So for me, I especially like family-owned businesses where the family are significant shareholders in the company, and their long-term financial interests are aligned with the interests of other shareholders. So for me, that's a really big advantage. I don't buy all the corporate governance gumph of saying that the founder or the big shareholder cannot be the chairman or CEO of the company because of a separation of powers. I think that a CEO who's a big shareholder in a company like Warren Buffett's another great example of this, who stays invested in the company and runs that company for his own interests as well as because he's a big shareholder, will be doing that for other shareholders as well. That's a simple alignment of interests. In South Africa, we've got a very good example of that with the Mouton family running PSG, or the Ruperts running Remgro. That for decades, that they've been running those businesses for the interests of the family, which are 100% aligned with the interests of the shareholders. So I love that idea. I think corporate governance people who resist that are definitely lawyers and accountants and the like, and have no concept of what it means to be an investor. So that would be my main points around what to look for in a company. There are lots and lots of others, but I think also key here is I want to buy those companies when they are trading at a discount to their real value. In other words, when markets are down and everybody's fearful, that's the time that I want to be buying those shares. I don't really want to buy those shares when they've been shooting up month after month for a couple of years, and the share price might be at a real big premium to its real value. And I think again, again, using Apple as an example, there was a time, let's say September, October 2021, where the share price was just really high. Nothing to do with the actual company. The company was being well managed by a very strong management team with a great product line, but the investment market had pushed the share price too high, and then by November it started to fall over along with all the other tech shares. And I think by kind of mid 2022, it suddenly looks at much better value again, and then I would be a buyer of those shares. So I think that's my other comment about buying shares: is your timing to go into the share is important, but then buy that share with the plan that you hold it for the next 10, 20, 30 years if you can. Then let's talk about exchange traded funds. So I'm conscious that we're running out of time on this already fantastic question, but let's say you're looking for an exchange traded fund that invests in the world markets, in the world stock market. There will be different versions of an index that the exchange traded fund is tracking. So let's just talk about let's say the MSCI World Index. Now, MSCI is a company, and they create an index of the world stock markets. So that the way that they calculate that will be different, for example, to S&P, Standard & Poor's, who might also have a world index, but they would use a slightly different methodology for replicating the world stock markets. So it is important to look at that when you're buying an index, to say, let me understand what it is that this index is actually trying to replicate, so that you understand what you're buying. And MSCI World Index, as an example, is actually only all the value of the stock markets of the developed economy. So it's got nothing to do with emerging markets. So if you're buying that, although it says World Index, you need to go and read up a bit more about it, and you can Google it. There's lots of information available on that to explain what the World Index is, and then also how MSCI will calculate that. And then you need to go and look at the S&P version of that, the Standard & Poor's version, and see how they calculate it, because they might have one called the All World Index, for example, which might include developed and emerging markets, and that might be what you want to buy. So I think it's important to understand that exchange traded funds they can be very simple. In other words, if you look at the top 40 index in South Africa, all that you're buying there is the 40 largest companies on the JSE. There is no real algorithm or something other than a mathematical calculation to say, take the number of shares available for a particular company, multiply it by the share price, and if that becomes the biggest company in the stock exchange, that will be the biggest holding that you will have in your top 40 index. And then you go to number 2 and 3 and 4 until you get to the 40th biggest company. And the index managers there will be doing that calculation. They don't do it every day or every month. They will rebalance that index, sometimes every month or every quarter, but they certainly won't be doing it every day. And all of that happens automatically. So when you're buying the top 40 index, you don't need to worry about chopping and changing underlying companies as their values are changing. That will be done for you by the index provider. Unfortunately, as time has gone on with the exchange-traded fund market, they have become much more complicated and much more varied and diverse. So there are now many thousands of different kinds of exchange-traded funds. So you can find some that are actually being launched by active managers who are buying and selling shares in an ETF. And you can find others that own balanced portfolios of assets that are, include cash, bonds, property, and shares. And you'll find ones that are very specific on gold or very specific on renewable energy or ESG investments and the like. So I think it's difficult to give you kind of a pointer to say, these are the ones you should look at. I would say I love broadly diversified ETFs. So buying the whole world stock market for me is generally preferable to saying that I know that I should buy the Japan ETF because that's the one that's going to do well in the next decade. The answer is I don't have a clue what Japan's going to do in the next decade compared to America. So I'd rather buy the world index. And when I'd make that decision, what I'm really looking at is the index provider or the ETF provider, big? And is the ETF itself, does it own a lot of assets? Because if it does, the costs of running that ETF are going to be relatively low for me because, there are fixed costs when you have an ETF. The audit fees and the custodian fees are generally fixed fees that the banks are charging the ETF provider. So if it costs $100,000 of audit fees and those kinds of things a year, That fee can be a huge percentage if your fund is only $1 million in size, but it's a tiny percentage if your fund size is $1 billion. So you're generally looking for bigger ETFs, I think, where the costs of running the ETF are very low. So that would be my view, and I would stay away from very specific, very sectoral ETFs or very active ETFs, because I'm not convinced that I know what's going on inside there. And then I could be surprised by a market event where I suddenly see a 20 or 30% drop in my portfolio, and I was only expecting a 5% drop. I hope that helps, and thanks for the question, Kerry. Thank you for listening to Honest Money. If you have any questions, you're welcome to reach out to me on Twitter. My handle is @WarrenIngram. Don't forget to subscribe. We're on Spotify and Apple Podcast. Chat soon.